You don't always lose money because your analysis is wrong. Sometimes you lose because you placed a trade that never needed to exist in the first place. That distinction is uncomfortable because it shifts the problem away from the market and back toward your own decisions. If you've ever looked at a chart after closing a position and realized you would have been better off doing nothing, you've already seen the pattern. Even if you didn't recognize it, the market has a way of rewarding activity just often enough to make unnecessary trades feel justified. A few fortunate outcomes can disguise poor judgment, while a string of losses convinces you that the next position must recover what the last one failed to deliver. Without realizing it, you stop responding to the market and start responding to yourself. The chart becomes secondary. Your recent emotions become the real signal. That is where many traders quietly lose control, not because they lack intelligence, discipline, or access to information, but because they mistake participation for progress. Every price movement begins to look like an invitation. Every missed opportunity feels like a mistake that must be corrected. The result is subtle but damaging. Patience begins to feel irresponsible, and waiting starts to resemble failure. Yet the market does not reward constant involvement. It rewards alignment. There are moments when conditions support a clear decision, and there are longer periods when uncertainty is the most honest reading available. The difficult part is that these two environments often look remarkably similar to an impatient mind. The trader who cannot tell the difference pays tuition to the market over and over again. So before you study another indicator, adjust another strategy, or search for a better entry, there is a question worth asking: that what exactly convinces you that a trade deserves your capital? Is it evidence from the market, or is it the discomfort of standing aside? The answer to that question shapes far more than a single position. It influences how you interpret risk, how you manage uncertainty, and whether your decisions are driven by observation or impulse. The insight that changes a trader rarely begins with a new technique. It begins with recognizing the hidden assumption behind nearly every unnecessary trade. Until that assumption becomes visible, every improvement you make will be built on unstable ground. And that is the first idea you need to understand before placing another order. If you'd like, I can also write the next segment so the entire speech maintains the same calm, philosophical progression from opening hook through the core keynotes. There is a kind of loss that rarely appears on a trading statement. It happens before the order is placed. The moment you convince yourself that you need to be involved simply because the market is moving, you've already accepted a risk that may never have been necessary. The trade itself is only the visible result. The real mistake began earlier, when the decision escaped your standards and became a reaction instead. The market does not ask for your participation. It simply presents information. Every candle, every breakout, every sharp reversal exists whether you act or not. Yet it is surprisingly easy to interpret movement as an invitation. After watching prices for long enough, your mind begins to confuse activity with opportunity. The more you watch, the stronger the urge becomes to justify your attention with a position. That is why unnecessary trades often feel reasonable in the moment. They are built on exposure, not on evidence. A worthwhile trade has a simple quality that is often overlooked. It survives the question, what happens if I do nothing? If standing aside creates no meaningful disadvantage, then the decision deserves another look before capital is committed. This is not hesitation. It is filtration. Every trade should be able to explain why it exists without relying on excitement, urgency, or the fear of missing a move. If it cannot, the market has not earned your participation. Notice how often weak trades begin with vague language. It looks ready. It might continue. I don't want to miss this. These thoughts sound harmless because they are familiar, but they share the same flaw. They lower the standard required for action. Once your criteria become flexible enough to accommodate uncertainty, almost any chart can appear tradable. The decision is no longer being shaped by the market. It is being shaped by your willingness to compromise. Imagine two traders looking at the same price chart. One decides to enter because there is movement. The other decides to wait because nothing has yet justified the risk. Hours later, the market rallies. From the outside, the first trader appears correct. But that outcome tells you nothing about the quality of the original decision. A fortunate result can make an unnecessary trade look intelligent. Over time, that is one of the market's most expensive lessons. It quietly rewards weak judgment just often enough to preserve it. This is why your first responsibility is not learning how to enter a trade. It is learning how to reject one. Every position you refuse for the right reasons protects more than your capital. It protects your standards. Once those standards begin to erode, rebuilding them becomes far more difficult than maintaining them in the first place. Good decisions are rarely destroyed all at once. They are weakened through small exceptions that seem harmless on their own. Before placing any order, pause for a moment and examine the reason behind it. Remove the chart from your mind and ask yourself whether your explanation would still make sense if no trade could be placed today. If the reasoning loses its strength without the possibility of immediate action, the decision may never have belonged to the market at all. The challenge, however, is that even when you learn to reject unnecessary trades, another problem remains. The market itself does not always make it obvious whether it is presenting genuine information or simply generating movement. Learning that distinction changes everything. One of the hardest skills in trading is accepting that not every movement deserves an interpretation. Price changes every second the market is open, but information does not arrive at the same pace. The chart is constantly speaking, yet much of what it says has no lasting meaning. If you treat every fluctuation as a message, you eventually stop hearing the signals that actually matter. Markets move for many reasons, and not all of them reveal direction. Some movements reflect genuine shifts in supply and demand. Others are temporary reactions, routine adjustments, or the natural process of buyers and sellers meeting each other. From a distance, these different causes can produce charts that look almost identical. That is why movement alone is such an unreliable guide. Motion is visible. Meaning is not. This creates a problem that every trader must solve. The market rarely tells you whether today's activity deserves attention or simple observation. It presents both with equal confidence. A sharp move may lead nowhere. A quiet period may be preparing something significant. If you assume that every change carries importance, you begin forcing explanations onto events that have not yet revealed their purpose. Instead of reading the market, you start inventing a story for it. Notice what happens when information is truly meaningful. It tends to remain consistent instead of demanding constant reinterpretation. One observation strengthens the next. Price behavior begins to support a single idea rather than several competing ones. You find yourself removing uncertainty instead of adding new possibilities every few minutes. Genuine information simplifies the picture. Noise usually makes it more complicated. This is why clarity often arrives more slowly than impatience would prefer. Meaningful market conditions have a way of becoming more obvious as they develop, while random movement demands immediate attention before it disappears. That difference matters. Noise pressures you to act quickly because it offers no stable foundation. Valuable information becomes stronger with confirmation because it is supported by something more durable than a brief burst of activity. A practical way to observe this is to stop asking what the market is doing and begin asking whether today's behavior changes your understanding in any meaningful way. If your interpretation shifts with every new candle, you are probably responding to noise rather than information. But if additional price action continues to reinforce the same conclusion without forcing you to rewrite it, the market may finally be revealing something worth noticing. Learning this distinction changes the way you spend your attention. Instead of reacting to every visible movement, you begin watching for consistency. Instead of searching for excitement, you search for evidence that continues to hold together as new information appears. The market becomes less about predicting every turn and more about recognizing when uncertainty has genuinely started to fade. That transition is important because even when the market begins offering clearer information, another question remains unanswered. Knowing that conditions are becoming more meaningful is one thing. Deciding how much of your capital deserves to be exposed to those conditions is something entirely different. Most traders notice capital only when it disappears. They pay attention after a large loss, after a painful drawdown, or after the account balance forces them to change their behavior. But capital begins shrinking long before those moments arrive. It is reduced every time money is placed into situations that never offered enough reason to justify the exposure. The account may still look healthy, yet its real strength has already begun to fade. Capital is often treated as if it exists only to absorb risk. In reality, it serves another purpose that is just as important. It gives you the ability to respond when better conditions finally appear. Every unnecessary commitment reduces that flexibility. Money tied up in average situations is money unavailable for exceptional ones. The cost is not measured only by what was lost. It is measured by what could no longer be done when genuine opportunity eventually arrived. Think of capital as stored decision-making power rather than simply a balance on a screen. Every dollar represents future choices. Once the choice has been spent, whether through a gain, a loss, or simply being committed to the wrong place at the wrong time, your range of options becomes smaller. That reduction may seem insignificant after one trade, but repeated often enough, it quietly changes the way you operate. You begin making decisions with less room to think, less room to adapt, and fewer alternatives available. This is why preserving capital is not the same as avoiding losses at any cost. There will always be losses in trading. They are part of participating in uncertain markets. The real objective is to ensure that your capital is being used where it has a meaningful purpose. When resources are allocated carelessly, even small losses become expensive because they consume opportunities that have not yet appeared. The damage extends beyond the immediate result. Imagine two traders with identical account sizes. One enters almost every acceptable setup, believing steady participation is the path to progress. The other waits through long stretches, allowing cash to remain unused until conditions become unusually favorable. There may be periods when the more active trader appears productive simply because money is constantly in motion, but activity is not the same as effective allocation. Capital that remains available is not idle, it is reserved. There is an important difference. This changes how you evaluate your account. Instead of asking how much money is available today, begin asking how much freedom remains. Can your current capital support decisions tomorrow without pressure? Can it withstand uncertainty without forcing compromises? A healthy account is not defined only by its size. It is defined by its ability to respond without limitation when conditions deserve action. That perspective also changes how you view restraint. Keeping capital uncommitted is not a sign that it is being wasted. It is often the very reason you remain capable of acting when others cannot. Markets regularly create moments that reward preparation more than participation, and those moments tend to favor traders whose resources have not already been exhausted by ordinary conditions. The challenge, however, is that preserving capital becomes much harder if you expect worthwhile opportunities to appear all the time. That expectation quietly reshapes your standards, and understanding why is the next piece of the puzzle. One expectation quietly shapes more trading decisions than most people realize. It is the belief that worthwhile opportunities should appear on a regular schedule. Not every day, perhaps, but often enough to justify constant readiness. When that expectation goes unchallenged, ordinary periods of uncertainty begin to feel abnormal. You stop seeing quiet markets as part of the process and start treating them as problems that need to be solved. The market has never agreed to provide a steady supply of favorable conditions. It moves through uneven cycles. Some periods produce several clear opportunities in a short time. Others offer very little that deserves attention. This uneven rhythm is not a flaw in the market. It is one of its defining characteristics. The difficulty begins when your expectations remain constant while the quality of opportunity naturally changes. Once you expect consistency where none exists, your standards begin adjusting without your permission. A setup that would have been ignored after a productive week suddenly looks acceptable after several quiet days. Nothing meaningful has improved in the market itself. Only your willingness to settle has changed. The expectation of regular opportunity quietly lowers the threshold for what feels good enough. This creates a dangerous illusion. It starts to seem as though the market has become difficult, when in reality it has simply become selective. There is an important difference. A difficult market suggests that better effort will uncover hidden opportunities. A selective market simply offers fewer situations worth acting on. If you mistake one for the other, you spend more time searching instead of accepting what the current conditions are actually providing. Watch how professionals in any uncertain field operate. They do not expect every day to produce meaningful results. They understand that valuable situations arrive unevenly, and they organize their work around that reality instead of resisting it. Trading demands the same adjustment. The goal is not to make opportunity appear more frequently. The goal is to recognize that its frequency was never under your control. This shift changes how you interpret slow periods. Instead of measuring success by how often you participate, you begin measuring it by how accurately your expectations match reality. A week with few worthwhile opportunities is no longer viewed as lost time. It becomes evidence that your standards remained intact while the market offered less than usual. The absence of action stops feeling like an absence of progress. Try observing the market without placing any demand on what it should deliver today. Notice how quickly the pressure begins to disappear when you stop expecting the next worthwhile situation to arrive on your preferred schedule. You become more willing to accept what is actually in front of you rather than searching for what you hoped would be there. Your interpretation becomes quieter because it is no longer competing with expectation. There is another expectation, however, that can influence your judgment even more than your assumptions about the market. It does not come from today's conditions. It comes from your own recent experience, and it has a subtle way of following you into the next decision before you even realize it. The market opens each day without remembering what happened to you yesterday. It does not know whether your last trade ended in profit, loss, or whether you watched a move unfold without participating. Yet many trading decisions begin with that personal history instead of the information currently available. The chart may be new, but the mind often arrives carrying yesterday's unfinished business. Recent experiences have a disproportionate influence because they feel more important than they really are. A fresh profit can make the next opportunity appear safer than it is. A recent loss can make ordinary uncertainty feel unusually threatening. Even a missed move can leave behind the feeling that you are somehow behind the market. None of these experiences change the conditions in front of you, but they quietly change the way you interpret them. This happens because the brain naturally searches for continuity. It prefers to connect one event to the next, even when no meaningful connection exists. A winning trade creates the impression that the next decision should follow the same path. A losing trade creates the urge to distance yourself from the previous outcome. In both cases, attention shifts away from the present market and toward maintaining or correcting a personal narrative. That shift is subtle but important. Instead of evaluating today's conditions on their own merits, you begin comparing them to something that has already ended. The current setup is no longer allowed to speak for itself. It is measured against your most recent emotional reference point. As that reference grows stronger, your ability to judge the present independently becomes weaker. Imagine a hypothetical example. You close a profitable trade after several days of patient waiting. The next morning, another chart begins to move. Because confidence from the previous success is still fresh, the new situation appears more convincing than it would have otherwise. Now reverse the example. Suppose the previous trade ended in a disappointing loss. The very same chart may suddenly seem uncertain, even if nothing about the market itself has changed. The difference is not in the price action. The difference is in the lens through which you are viewing it. One useful habit is to treat every trading session as though the previous one belonged to someone else. Not because past results are meaningless, but because they are complete. They have already done all they can do. The only information they still possess is what they can teach through later review, not what they should dictate in your next decision. Today's market deserves an independent evaluation, free from the momentum of yesterday's outcome. Before interpreting any new setup, ask yourself a simple question. Would this look the same if my previous trade had never happened? That question interrupts the quiet influence of recency. It forces your attention back toward the evidence that exists now rather than the outcome that already belongs to the past. Often, that brief pause is enough to separate current observation from lingering memory. The challenge, however, is that even when you free yourself from the influence of recent results, another mistake remains surprisingly common. You may begin seeing familiar patterns clearly, yet still misunderstand what those patterns are actually telling you. That distinction deserves careful attention next. There comes a point in every trader's development when familiar patterns begin to appear everywhere. A chart forms a shape you've seen before, and your mind immediately fills in the rest of the story. What once required careful study now feels obvious. This progress is valuable, but it also creates a new danger. Recognition becomes so fast that it starts replacing evaluation. The human mind is designed to recognize patterns. It helps us make decisions quickly by connecting the present to past experience. In trading, that ability is essential. Without it, every chart would look unfamiliar, but pattern recognition has a limitation. It answers only one question. Have I seen something like this before? It does not answer the more important question. Does this pattern carry the same meaning today? A chart pattern is never an isolated event. It exists within a larger environment that gives it context. The same structure can appear under completely different conditions and lead to very different outcomes. A breakout may signal genuine strength in one situation and simple exhaustion in another. A pullback may represent healthy continuation one week and growing weakness the next. The shape has not changed, but the surrounding conditions have. Ignoring that difference is what turns recognition into assumption. This is why experienced traders rarely become impressed by the appearance of a setup alone. They understand that a pattern is only a piece of evidence, not the entire argument. Evidence gains value through its relationship with everything around it. Remove that relationship, and even the most familiar formation becomes incomplete. The chart is not asking to be identified. It is asking to be understood. Notice what happens when recognition arrives too quickly. The moment you label a setup, your attention naturally begins searching for reasons to support that label. Details that fit the pattern stand out more clearly, while conflicting information becomes easier to overlook. Without realizing it, the conclusion arrives before the investigation has finished. The chart is no longer being observed. It is being confirmed. A useful habit is to delay naming what you see. Spend a moment describing the market in plain observations before attaching a familiar label to it. Ask what price is actually doing instead of what the pattern is called. This small change forces your attention back toward evidence rather than memory. Often, the chart becomes more informative when you stop trying to classify it too quickly. Over time, you discover that confidence should not come from how many patterns you recognize. It should come from how often you resist assigning meaning before enough evidence exists. The trader who sees fewer opportunities but understands them more completely is usually operating with greater clarity than the trader who can identify every textbook formation on the screen. Recognition is a valuable skill, but by itself it never creates a worthwhile decision. A familiar pattern may deserve attention, yet there is still another question that remains unanswered. Even when your interpretation is sound, how that idea is carried into action can determine whether a good observation remains valuable or quietly turns into a poor trade. A trading idea does not succeed simply because it is correct. Between understanding the market and committing capital lies a series of decisions that can quietly change the quality of that original idea. The analysis may remain sound from beginning to end, yet the trade itself can still become poor, because the execution no longer reflects the conditions that justified it in the first place. This usually happens in small ways rather than dramatic ones. A trader identifies a situation that meets clear criteria, but then enters earlier than planned because the move appears to be accelerating, or confirmation was supposed to arrive first, Yet it is ignored because waiting feels unnecessary. Nothing about the market forced these changes. The original plan simply began to drift. As each condition is relaxed, the trade becomes less connected to the reasoning that created it. Execution is often misunderstood as speed or precision. In reality, its most important quality is consistency. It answers a simple question. Does the action still match the original decision? If the answer becomes uncertain, execution has already started to weaken. The problem is not that the market changed. The problem is that the relationship between the idea and the action has changed. Think about how easily conviction can create impatience. Once you believe you understand what the market is doing, every passing moment begins to feel expensive. Waiting for the planned conditions may seem unnecessary because the conclusion already feels obvious. But confidence does not remove the need for discipline. If anything, it makes discipline more important. The stronger your belief becomes, the easier it is to justify abandoning the process that produced that belief. Imagine a hypothetical example. A trader decides that a position should only be taken after price confirms a specific level. Instead, the trader enters moments before that confirmation because the move looks close enough. The market then reverses before reaching the planned condition. The original analysis may still have been reasonable, but the trade was never the one that had been evaluated. It became a different decision the moment the conditions were changed. One useful habit is to separate your market opinion from your trading action. Treat them as two independent questions. First ask, do I believe this idea has merit? Then ask, have the conditions required to act on that idea actually appeared? A positive answer to the first question does not automatically answer the second. Keeping those questions separate protects the quality of your execution. Over time, disciplined execution creates something valuable that is often overlooked. It allows you to judge your own decisions fairly. When actions consistently follow predefined conditions, outcomes become easier to interpret because you know exactly what was tested. But when execution constantly changes, every result becomes difficult to evaluate. You are no longer measuring the quality of an idea. You are measuring a different version of it every time. That distinction becomes increasingly important because traders often judge themselves by what happened after the trade instead of how faithfully the trade reflected the original decision. Understanding that difference changes the way performance itself should be measured, and that is where the next lesson begins. One trade is too small a sample to tell you who you are as a trader. Yet it is remarkable how often confidence rises after a single profitable position and disappears after a single losing one. When each result becomes a personal verdict, your understanding of progress becomes unstable. The market is uncertain by nature, but your self-evaluation becomes even more uncertain because it changes with every outcome. The problem is not that individual trades matter. They do. The problem is assigning them more meaning than they can reasonably carry. Every trade exists within a field of uncertainty. A well-reasoned decision can still produce a loss, while a weak decision can occasionally produce a gain. The outcome alone cannot reveal the quality of the process that created it. It only tells you what happened once under a specific set of conditions. Imagine judging the accuracy of a weather forecast based on a single afternoon. A correct prediction may appear wrong because conditions changed unexpectedly. An inaccurate prediction may seem brilliant because chance happened to agree with it. Only after observing many forecasts does the true quality of the process begin to emerge. Trading works the same way. One result contains too much randomness to serve as a reliable measure of your ability. When traders become attached to isolated outcomes, they begin chasing emotional balance instead of consistent improvement. A profitable trade becomes proof that everything is working. A losing trade becomes evidence that something must immediately be fixed. As a result, methods change too quickly, confidence fluctuates unnecessarily, and lessons are drawn from events that simply do not contain enough information to justify those conclusions. A more useful question is not, did this trade make money? But, would I willingly make this same decision again if faced with the same information? That question shifts attention away from the outcome and back toward the quality of the reasoning. Sometimes the honest answer will be yes, even after a loss. Sometimes it will be no, despite a profit. Those moments are where genuine progress begins, because they separate decision quality from short-term reward. This perspective also creates patience in learning. Improvement no longer depends on finding immediate confirmation from the market. Instead, it depends on repeating sound decisions often enough for their strengths and weaknesses to become visible. You stop demanding certainty from every position because you understand that no single trade was ever capable of providing it. Over time, this changes the emotional weight carried by each result. A loss becomes information rather than identity. A gain becomes evidence, not validation. Individual outcomes remain important, but they no longer control your understanding of yourself as a trader. They become part of a larger body of work rather than the final judgment on it. There is another advantage to thinking this way. Once you stop searching for proof inside individual trades, you become better prepared to ask a more valuable question.